Well, thank you for that. Good morning, everybody, and welcome to the Small Business Center here in beautiful Belleville, Ontario. Today, we have a workshop that is going over the key concepts of cash management, working capital, and operational efficiency. Before we get going, I'd like to introduce to you my co-partner here, Brianna, who's teaching me everything. Today's my first shot, so please excuse any, stuff. I'd also like to introduce Chantel. Olette. She's the administrative and communications assistant for Trinval, which is part of our funding and part of our office. Welcome, Chantel.
Awesome. Thank you, Tamara. So for those of you who don't know what Trinval is, we are a community futures development corporation. We are federally funded, and we basically are there to support any business at any stage. We offer business resources, business counseling, and business financing options. So we offer financing up to $300,000. So if anybody is interested in learning more about that, they're more than welcome to reach out to me directly. I'll include my contact information in the chat. So if anybody wants to reach out, you're more than welcome to. Our service areas include Belleville, Cluny West, Sterling Rawdon, Tyandanega, and Deseronto. So if anybody's looking to start up a business there in any of those locations, we would be happy to help. Thank you.
Thank you, Chantel. So today I would like to introduce everybody to Lola. Lola is a financial professional with extensive experience in finance planning, analysis, and business partnering. She delivers financial targets for organizations. Currently, Lola works with Johnson & Johnson in the financial planning and analysis space, and she helps businesses deliver on their targets and takes advantage of all the opportunities in the market. Good morning, Lola, and welcome. It's all yours.
Okay, hi, good morning, everyone. Thank you, Chantel, for your introduction as well. So very quickly, I'll be talking with business owners, as I was told, on how to maximize your business. It's one thing to start a business. It's another thing to ensure that your business is able to grow and scale up, and that you're able to attain operational efficiency for your business. So very quickly, I would like to say it's a pleasure to be here today. My name is Lola. I'm a CPA. I'm based off of Toronto. In this presentation, I'll help you to understand the key concepts of cash management, working capital management, operational efficiency. I'm going to explain what all of those mean. So we have about an hour to go through this very quickly. You will also get copies of the presentation at the end so that you can refer to them to refresh your knowledge of what we discussed today. So let me use this. So it's let me know, is there any? Is it better? Okay. Okay. So you'll get copies of the presentation as well at the end. And then this session is supposed to be interactive. So if you have any questions, please feel free to ask them as we go along. And then if you also have questions at the end, I will take your questions at the end as well. So if I may ask, if one or two people can let me know, what kind of business do you render, like offer? Is it a service-based business? Is it a product or physical goods business? So if anyone is willing to share what kind of business they run. I think there's just one person.
Yeah, it's just right now, it's just me.
Right.
And I'm kind of in the planning stage right now. I have a couple of concepts and ideas that I'm playing with, and I am working with Luke over at the Small Business Center because I have talked to Chantel at Trinval and have gone to Trinval before starting another business. So that's pretty much where I am. So I have a couple of business concepts and ideas that I'm working on right now.
Okay. Okay, thank you very much. Also, just to put it out there that this session is presented to you by CPA, Chartered Professional Accountants of Canada. We have about 217,000 members worldwide. And we are respected across the globe for our knowledge of finance and accounting. So very quickly, I'll share with you my slides. Let me share. Okay, so you could just leave me a thumbs up or something in the comment to let me know that you see my slides.
We can see.
Okay, cool.
Yeah, I can too. I can't find a thumbs up message, but yes.
Okay. So, so here are some of the most common questions that business owners ask when they start businesses and they do not understand exactly how to handle the financial aspects of the business. You hear questions like, okay, I'm selling so well, my products are moving so fast, but we do not have any money, right? So sales are great, why don't we have cash? Or we'll say, do we have enough cash to pay our expenses? So even though this business, it's possible for a business to be performing so well, but then there's not enough cash to pay up your bills. There's also the question of how much cash do we need for expansion? Maybe you're looking to scale up your business and you're not sure exactly how much you will need to do that. Can I free up some cash from the business? You know, how can I get customers to pay sooner than later? And then are we managing cash efficiently? So I know that this may be some of the questions that some of us might have on our minds as we came into this session, and we'll be going through them very quickly and what the answers to these questions will be and what to look out for in your business. So this slide shows you the typical business cycle from the start to the finish. And in this case, this business cycle is an example of a product-based business where there are physical goods that are being sold. So typically you will buy the inventory and stock up on them to be able to sell to your customers. And then when you buy that inventory, you're going to spend cash because you're paying the person you're buying from, your suppliers, cash to get the inventory. Then the customer orders for these products. Then you have to pay your bills. So maybe the rental fee for the store location you're using, maybe electricity, all the bills attached to that business you'll have to pay. That's also money being spent. And then at the end of the cycle, you receive payments from your customers. So that's the only point when cash flows back to you. So the basic question is, where do I get the cash to spend to buy the inventory and to pay my bills before I receive payments from my customers? So the summary of this slide is, a business must always have cash available to be able to operate. Otherwise, operations will take a nosedive. Next slide. So I'll be introducing you quickly to the concept called working capital. Okay, I thought someone had a question. So I'll be introducing you very quickly to a concept called working capital. So when we talk about working capital in finance, what we're talking about is how much do you need to efficiently run your business? How much of your capital, how much cash do you need to run your business effectively? And there is a formula to getting that. So the formula for current working capital would usually be your current assets less your current liabilities. So working capital is a measure of the liquid assets that are available to be used in the operation of your business. When we talk about current assets, we're talking about assets that can be easily converted to cash in the current period. So just look at current assets as assets that can be converted to cash in the current period. And current periods in finance will usually be a year, a space of 12 months. So cash is already cash, so that's a current asset. Inventory, the assumption is that inventory you would intend to sell them within the next 12 months. So that's also something that can easily convert to cash. And then accounts receivables is the amount that your customers owe you. So when you sell on credit, that means you've not received payment. That value, so if you sell something worth of $10,000 to a customer on credit, you're going to record that as accounts receivables because they haven't paid yet, and you expect to receive that amount within the next 12 months. Sorry. So current liabilities, on the other hand, same concept with current assets. These are liabilities that will happen to fall due within the next 12 months in the current period. So things like accounts payables, that's the money you owe. So that's the direct opposite of accounts receivables. So accounts payables are the amounts that you owe your creditors or you owe your suppliers. So say you bought something from your supplier and you haven't paid, that amount is accounts payables. So the concept of working capital is, if I add my cash and all the assets that are easily converted to cash together, and I remove my liabilities, that's the amount I need to pay out, what is left? What is going to be left for me? That's your working capital. So based on that formula, the higher your working capital is, the better for you and your business, because that means current assets are high and you're keeping your liabilities low, which is a great thing. So I'll move to the next slide to give a practical example of how working capital works or how you can calculate this for your business. So you have current assets. For this business, there's cash of $10,000. You have inventory in your store, $20,000. You have accounts receivables, that's payments that you've not received from your customers at $75,000. So your total current assets will be $105,000. Now note, cash, inventory, and accounts receivables are not the only current assets. If you think in the concept of your own business, any asset you hold that can be converted to cash within the next 12 months is a current asset. So just putting out there that these are not the only three items that are current assets. Same with current liabilities. Any liability, anything you owe that will come due within the next 12 months, please recognize those as current liabilities. So for this business, the working capital is a simple deduction of the current liabilities from the current assets. So when you remove $15,000 payables from $105,000, you have $90,000 as the working capital for this business. And that simply means that you have $90,000 available to support the operation of the business. This just means when you remove your obligations, your bills, your payables from the assets, this is what you have left to support operations of your business. Please, like I said, if you have any questions anywhere in between, anything you don't understand, please feel free to ask me. Just stop me right in my tracks.
Okay, I have a quick question.
Okay.
About accounts receivables specifically. Right. Now you said that those can be included in your assets as long as they'll be able to be sold over, or that money. So they've already been sold, but that money is owed to you, correct?
Yes.
So what happens outside of that 12-month period? So let's say I sold a product that I made for $10,000. We'll use the obvious thing. And you have that $10,000 owing over the next year or sometime within the next year, and the end of the year comes and that $10,000 hasn't been paid.
Okay, so you sold goods worth of $10,000, and you expect it to be paid, but at the end of the 12 months, it wasn't paid.
Correct.
That's what you mean. Okay, so that's moving to another concept entirely. But at the point where you make those sales on credit, because this will usually be financial statements prepared either monthly or quarterly, depending on how you run your business, you're going to have to immediately that sale is done, record this as an account receivable. At the end of the period, if you do not receive these monies, there's something we do in finance where we review our debts. So this account receivable, what was the reason why we did not receive it? Is it because the customer is bankrupt? Is it because they're just not paying up? Do we then have a concept where we write off some debts as bad debts? That's a loss to your business. So, okay. I mean, we have no control over when we will receive the payment, and if so, that's why we have the concept called bad debts, where if you don't receive that money and then you deploy all means to do the debt collection and it's still not coming through, then unfortunately, there's a portion in the financial statements for bad debts.
Okay, perfect. Yeah. Thank you.
Thank you for that question. Okay, so working capital and sales growth. Like I said before, to grow your business, you need the higher the working capital, the better for your business. And quickly to the formula, you want to keep your assets higher than your liabilities to be able to get good sizable working capital for your business. So let's assume you want to grow your sales or you want to grow your business generally. What are the sources of additional working capital for your business? It can be cash on hand. That means you have cash, you inject the cash into the business. It could be additional investment by the owners. Say it's a sole proprietorship or a partnership, and the partners are willing to ingest more money into the business. So that's also an additional source of working capital. You can also onboard new investors to your business to put in funds to run the business. And you can get loans from lenders, banks, and the works. That's also an additional source of working capital. So these sources should be identified before they're needed for growth. You want to know where you want to source your working capital from before the time that you need to grow your business. Okay, so understanding operational efficiency. Operational efficiency can be measured by how quickly sales are converted to cash. Everyone who sells something wants to sell it as soon as they can. No one wants to hold inventory in their stores for a very long time, right? So we have some ratios in accounting and finance that help us track this, because it's difficult to just think off the top of your head if you're running efficiently or not. So some of the key efficiency ratios we have are days in inventory. That's how long your inventory stays in stock. You have collection period. You have payment period. I'll go over them. Each one of them has a slide. You have cash conversion cycle, and you have inventory turnover. So if you want to improve your operational efficiency, you would have to track these key ratios, and I will go over them in each slide with examples. So for instance, days in inventory, this calculates for you how long your inventory stays in the company before you sell it. There's a simple formula for this as well. And don't worry about this. You're going to get the presentation after the session. So when you want to calculate the days in inventory, you're going to have to pick your ending inventory. So let's say you're dealing with a month. What's the value of inventory you have in stock at the end of that month, divided by the cost of goods sold per day. Now, your inventory, let me pick maybe what store now? Maybe a store that sells clothes. And when you look at the inventory you have at the end of the month or at the end of the year, depending on when you do your financials, what is the value of these clothes that I have left in the store now? That's what goes as the numerator, ending inventory. And then cost of goods sold per month. The cost of goods sold per month can be found on your profit and loss statement. However, I understand some people don't currently have financial statements for their businesses. So cost of goods sold is basically the cost of the materials that you bought to run your business. So I'm selling clothes. I buy the clothes from a manufacturer in another country. The cost of those goods is the costs at which I bought those clothes, right? So when you look at your sales for that period that you're looking at, how many clothes did I sell? Maybe 5, and the cost of each one was 200. So your cost of goods sold is 200 times 5, that's $1,000. So that's what cost of goods sold is. So you're looking at cost of goods sold per day. We normally assume a 360-day year and a 30-day month. So that cost of goods sold divided by 30 days will be your denominator here. And then your ending inventory will be your numerator. So on the average, your inventory stays 33 days before you sell it. This is a key KPI for every business that they should look out for, because you want to get this number as low as possible. So the next one that you can look out for, the next key efficiency ratio that you can look out for is collection period. And this is how quickly payment is received from customers. So when you sell things on credit, how long does it take before your customers pay you back? Now, one of the best ways to handle this is to have a collection policy where maybe you say invoices or sales done on credit payment should be made in the next 30 days. So it's always best to set a policy for your business. However, you also want to track that people are actually complying with this. So there's a formula for that as well to give you insight into how many days it takes to receive your payments from your customers. And this will typically be your ending account receivables. That's at the end of the period in question. How much do I have left out there that I am being owed? You're going to divide that by your revenue per day. So like I said, assume a 30-day month and divide your revenue in that month, if it's by month, by 30. That's, in this instance, the revenue is 50,000, number of days 30. You're going to divide 75,000, which in this example is the ending account receivable, by that. And 45 days simply means that it takes your business 45 days to get monies or payments from customers. The next one is the payment period. This is how quickly vendors and suppliers are paid. Now, this is outflow for you. This is how quickly you pay the people you owe, your vendors, your suppliers, your lenders, how quickly you pay them. So same concept, your ending accounts payables divided by your cost of goods sold per day. So your accounts payables at the end of that period, how much are you owing your vendors, divided by cost of goods sold per day. In this example as well, we see it's 25 days, which means you pay your suppliers, your vendors, after 35 days from receiving the goods that you got from them. Also, all those efficiency ratios that I just spoke about come together to let you know what your cash cycle is. So the cash conversion cycle measures the length of time that cash is tied up in your company. So, you know, I said at the beginning that it's possible for your business to be doing well and there's no cash to run the operations because the cash is tied. It's either tied in inventory, maybe you've purchased 1,000 clothes and maybe you only typically sell 30 in the month. So you have a lot of assets, you have a lot of money, but you don't have cash because it's tied up in your store as inventory. So you want to also monitor the cash cycle because you don't want to tie cash down for so long a period that you then have problems meeting other obligations. So how to calculate the cash conversion cycle? From the formula for days in inventory, you're going to put your days in inventory plus your collection period minus your payment period. So your days in inventory plus your collection period, that's how many days it takes for you to get your own payments back from your customers. And then you subtract the number of days it takes for you to pay your vendors. So in this example, the cash conversion cycle is 53 days. That means your cash is tied down in the company. After 53 days of you investing your cash, you only get it back after 53 days. That's what this means. It's also known as the cash collection cycle. So that's one thing to put your focus on, and you want to keep that as low as possible. So the next thing is inventory turnover. And this measures how many times a year a company sells or turns over its inventory. So how many times does the company turn over its inventory in the year? And this is basically cost of goods sold that I spoke about before, divided by the value of the inventory that you have at the time you're calculating this ratio. In this example, they have inventory worth of $20,000 in store, and the cost of goods sold so far that year has been $18,000. So this means that the company has sold its inventory 0.9 times. Ending inventory can be found on the balance sheet, but like I said, if you don't have a financial statement and your business is such that you can measure your inventory, then you can do that. Just know the value of what you have in store. And then your cost of goods sold is basically the cost that you spend to acquire those products that you sell. Okay. So at this point, I'm going to make it interactive because I feel like I am talking alone. So if I may ask, if anyone can when you think about it in the concept of your business that you currently run and your inventory, when you think about your inventory, let me go back one slide. When you think about your inventory, what do you think you can do better to manage your cash to ensure that I'm already giving away the answers, but what are you, what do you think that you can do when you think about inventory? What do you think you can do better versus maybe what you do now, or what do you currently do? How do you currently manage your inventory?
Well, right now for me, I have a large inventory. So I'm kind of stuck in that I don't have a lot of, it's tight, as to use your words, too tight. So for me, it's the credit extension and then the receiving of payments on that account that is where I'm kind of locked into.
Okay.
So I don't know whether that exactly answers your question or not.
Okay.
I have a lot of assets.
Right.
They're just not
Enough cash.
Yes.
Right. Got that. I mean, that's a typical problem. And that's why these ratios are there in the first place, so that, you can visualize and then calculate and see where you actually stand. So, I mean, that's not that's not odd, right? That's something that is a regular occurrence. And that's why I came back to this slide. And thank you so much for your answer, because it's one of the answers that I have. So thank you so much, because you were spot on. What you want to do for the payment, you talked about credit extension, right?
Correct.
Yes. And for normal arithmetic, if this value here, payment period, is high, it will reduce this cash conversion cycle. Correct?
Correct.
Yeah. So what you want to do with this to manage your cash conversion cycle, because like I said, for this one, the lower, the better. So if I want this 53 days to go down, for instance, I may want to negotiate credit terms that allow me pay much later. It's the opposite for receivables and for collections and payments. For collections, you want to collect your money as soon as possible so that this number goes down. Okay. And
Right.
then you want to increase your own credit terms, such that maybe, for instance, the way credit card runs, where when you start to spend monies now till the end of the cycle, which is typically 30 days or something, you don't have to pay back. So the longer you have to pay your own suppliers, the better for you, because you still have cash with you that you can use for other things. So let's assume that this payment period, we increase it to 45 days. And this collection period, where you are able to get our money back quicker, it will reduce this by about 20 days. It will reduce your cash conversion cycle by about 20 days. So thank you very much, because that's one thing to look out for. If you're able to negotiate payment period, that will give you more headroom and more time before you pay back, it's always better. But if you're using credit cards, please be mindful of your cycle so that you don't miss a payment period.
No,
Okay.
I avoid credit cards like the plague.
No, they're good. They're good. It's just to pay attention to them. I mean, they're good. They're good for you to leverage, because I mean, like for instance, if you don't have cash and you have a credit card of 15,000, of course, I'll tell you to use it, as long as you know that you're keeping track of the payment period. You don't miss a payment. You don't earn unnecessary interest that you don't need to, pay back, and then, I mean, they're there for you to leverage and grow your business. So please, it's not the devil, it's just to manage it well. So yeah, I'll move on to how to improve efficiency inventory. So what you want to do is to prevent inventory being too much in your store. You have to sit down with yourself and your business partners to determine what customer demands are and what sales have been historically. So let's assume that you check for the last 2 years, and on the average, every month you sell about 50 boxes of perfume. I've changed the business now. You only sell 50 boxes of perfume every month. And then you're stocking 1,000 boxes of perfume every month. That's something you want to check that, okay, historically, based on trend, this is the trend. We do 50 at most, 30 at least. So don't tie your money down purchasing inventory that you don't need. You also want to eliminate slow selling items. So when you evaluate all of your inventory, you want to know which ones are selling so slowly. You don't want to stock up on things that are not selling, because I mean, if they don't sell and they're past their expiry, that's a waste. You have to write that off, right? So you don't want to stock up on things that are not selling fast. You also want to reduce your buffer or safety stock. I know a lot of us don't want to run out of stock so we don't disappoint our customers. And that's where the first point is key, where you evaluate your customers' demands and sales. That way you're able to make a more realistic view of what you will need and reduce the safety stock that you have. Also optimize your order cycles and quantities. This way, it helps you reduce the amount of stock that you hold, and then you can receive deliveries more frequently. So you also do not run at the risk of stocking things that will soon expire or expire in your store, and then it's a loss to you, or stocking things that people end up not buying. So you may want to optimize your order cycles and keep an eye on the sales and demand. There is no cast in stone numbers. If you do this for a period and you see that, oh my goodness, we're running out of stock, you may want to evaluate, as your sales grown, is there more demand? Then you can increase that number of inventory. So it doesn't mean what you start with is what you must stick with. This is something you regularly update. Then you can utilize direct ship as well. So there's some people who sell, there's some stores that sell like very expensive assets. So think about it like, say, maybe you're selling things worth of, maybe you're selling jewelry and then you have very expensive jewelry that you sell. Instead of stocking those inventory in your own store, you can leverage the fact that you stand in as like a middleman. And when you receive orders for those items, you can then have a direct ship from the manufacturer to your client. That way, it saves you the risk of having obsolete or items that will not sell, or tying your cash down in your store. And then eliminate obsolete inventory. This is a no-brainer. Inventory that has gone obsolete, eliminate it and just make sure not to fall back into this position. Okay, so this is another question. I like when I'm the one that asks the questions, right? So for collection period, now, if you remember, this is how long it takes for you to get your monies back from the people who owe you. What are some of your methods in improving efficiency and speeding up payments from your customers? What do you do? Do you sell on credit? That's the first question. If you do sell on credit, what are the methods that you use to improve efficiency and speed up payments from your customers? Anybody?
Well, it would be credit extension as well, offering more credit sometimes, seeing what you can do to help them speed up payment would make sense. Or if there's anything that you can do to help that process happen quicker.
Okay, so if you recall what I had said, collection period, this is not the payment period, right? This is the one where you are the one who is waiting to receive your monies from customers. So you don't want to extend this one. What you want to do is to reduce this as much as possible. So, and that's why I'm asking, to improve efficiency and speed up payments, the solution will not be to extend your credit time, because that will then mean you're extending the time when you're going to collect your money from your customers. So what you want to do here, if you want to manage your cash more effectively and make sure that you have cash to run your business, you want to ensure that there are businesses, for instance, that offer payment discounts. they sell on credit, and then they say if you pay within the first 30 days, we'll offer you 2% or 5% discount. It really is an incentive for you to pay them back quickly. That's usually the motive behind those payment discounts. So there are businesses that employ that means to make sure that their customers pay them in time. So they say, okay, pay back, in the next 30 days, and then you get so discount on your payment. So that's one way. Another way is to make sure that your invoices are sent promptly. Sometimes this delay comes as well from the business owners, where there's a lot of processes in-house, and before the invoice even gets to the customer, maybe it's already 10 days past the purchase date. That will automatically increase the collection period. So you want to make sure that you send out your invoices promptly. And that your invoices are correct, so that there are no cases where they keep coming back to say, oh, okay, we need to fix this error, and then extend your collection period further, right? You also want to make sure that you enforce payment terms. So for your business, you have payment terms, maybe payments are due within 16 days. You want to make sure that you enforce those payment terms as well, and that payment deadlines, like I said before, you can say eligible for discounts, just to incentivize them to make the payments quickly. You also want to monitor and react to those who have failed with payments. So if you're able to identify, and that's one thing under credit management, if you're able to identify a certain customer of yours that buys things and is usually delinquent in their payments, or pays very late, or does not stick to the payment terms, you may want to review your credit arrangement with such a customer. You may want to start to collect cash upfront to deal with this customer. You just want to also monitor that to be sure that you reduce your potential, like I spoke before, bad debt, where you don't have to write off debt at the end of the period. And then you also want to resolve disputes quickly. If there are any disputes regarding the product delivered, the invoice sent, you want to resolve this quickly to reduce your collection period as well. You also want to use electronic payment methods and billing. That I'm sure is not much of a problem with most of us here, but this will save time, mailing time, if you had to send like physical invoices or checks and all that, and it will reduce float time for checks. So you want to automate your payment system as well. Okay, I'll move to the next question. And I actually want another person to answer as well. So I know I'm not speaking to an audience of one. So for your collection period, okay, we're still on correction period. It says, what are some of the ways to improve your payment efficiencies? Does anyone want to answer? Or should I put people on the spot?
Definitely put people on the spot.
Okay, so I'll just look for the first person I see. I think it says Cassida Hamilton. I hope I'm not pronouncing that wrong.
Hi.
Hi.
What did you said something directly to me?
Yeah. So this
What was the
question on
Sorry.
the screen, yeah, I'm saying, what are some ways that you can think about that can help you improve your payment efficiencies?
Well, one of the things that we've been doing is what you said before, not pulling in too much inventory, so that we only pull in what we can manage with our cash flow, current cash flow.
Okay, that makes sense. Okay, so
it sometimes costs us a little bit more in the end, because it means more for transportation and bringing in stuff. But like the previous speaker said, we don't use credit cards, so we depend solely on what we have on hand. So we stick to what we can manage in the current period.
Okay, thank you. But then when you say that it costs you a bit more, one way to watch out for that will be to, like I said in the previous slide, look back on the trend of your sales so that you're not, maybe your current sales level is about 300 units per month and you're buying inventory of just 10 units. You're going to keep having to buy and, you know, spending, duplicating the delivery fees and all the logistics fees that are associated with that. So if you're able to do that, that should reduce the amount that you say you spend extra on, you know, having to do all those many recurring orders, if you get what I mean.
The cost of doing an order is zero. What costs us is the actual transportation to get it delivered to us. Or
Yes.
yeah, so
Yes.
that's our expense.
So if you're ordering 300 things at once, it's the same fee with ordering 10 things at once. So if you order 10 things 30 times, you're going to pay that transportation fee 30 times, as opposed to paying it once if you were already able to evaluate your sales and customer demands. Does that clear that?
It does, and I would see a lot of sense in that, except that we have so many limitations. It's just absolutely nuts. Space for one to put all of that stuff that we need to order, it's not available, and sometimes our business is a little unpredictable. Depending on the season, we may do very well this week, and next week we have such a lull that it's, you know, you wonder where the people went. So I don't know.
Okay, I mean, I struggle to hear you, but I know that you were talking about the same logistics fees and all that, and managing cash. And that's where all the ratios that I spoke about earlier come into play to make sure that you're implementing all of these things. You're not stocking more than what you need. No matter the size of a business, to be honest, no matter the size of a business, as long as they're able to manage their cash conversion cycle, they will be fine, because the business will always have enough cash to run itself. The only place where there's usually no cash is when there's a mismanagement of your working capital, where either cash is stored in inventory or you're paying off your debts too quickly and you're not receiving your own payments quickly enough. So it's in that mix that the solutions to all these problems are, right? Okay, so I'll just talk through my points on how to improve, or on some ways to improve your payment efficiencies. So first, a business should manage when its bills are paid. And this is where we talked about, you know, credit negotiation to extend the days for your credit, and then paying bills when they're due, so that you don't have to pay any penalties and then spend money paying penalties because you did not pay your bills when they were due. Also, maximize discounts when they're available. So if you see that there are discounts available for payment, I mean, take advantage of those discounts as well to reduce your cash payment. You also want to negotiate payment terms with your suppliers. And then if delaying payments to your suppliers, you have to consider your relationship with the supplier, especially if that supplier is key to your business, and ensure that there are no hidden charges for late payment and no interest charges for late payment. So some suppliers, depending on the relationship you have with them, are able to extend the payment terms for you without any of those penalties. So it's just a watch out to improve this efficiency for your payment period. This is actually payment period. Okay, so I have another example here. And I'm talking from the example of the business we had before. And here we are trying to improve the efficiency of that business in that example. So for instance, we're reducing inventory by 10%. So because we reduce inventory by 10%, the days in inventory has dropped to 30 days. That means our inventory is now only held for 30 days instead of, I think, 33 days that it was in the previous example. Also, the collection period, the business has improved its collection period by moving its customers to an electronic payment process. And we're assuming that it has modified its processes to invoice more properly and accurately. So the electronic payment process saves 4 days in the collection period, right? And then the fact that we invoice promptly saves 5 days. So in total, we're moving collection period from 45 days before to now 36 days. So another part of the process that we're improving is the payment process, where we are paying our own vendors. And we've also improved the payment process by paying our bills when they're due. And that's 3 days later. So let's say your bills are due on the 31st of the month. Take advantage of the full time of the 31st of the month. As long as you don't pay late, there's no penalty. But you don't want to pay like on the 27th, and then there's an obligation that falls due between the 27th and the 31st, and you don't have cash to pay. So if they give you to the 31st of the month to pay back your bills, you can pay back on the 30th, you can pay back on the 31st. So this improvement we did here was to say we will pay bills when they're due, and that's 3 days later from what we currently do. So that also took the payment days, that's this 28, it now is now 28 days, which is an improvement from where we were coming from in the previous example. Now, before, the cash conversion cycle was 53 days, but with this little improvements and adjustments that we've done, we've been able to bring down the cash conversion days to 38 days. By reducing inventory, by improving our collection processes, and by improving our payment process. So like I said, these are the 3 key areas that you can look at to manage the cash available in your business. And the same example, if you remember the example of the working capital calculation that we did, from this efficiencies that we've just implemented, our current assets, our cash still remains 10,000. We have inventory of 18,000, accounts receivable of 60,000. This is now 88,000, down from 100 and I think it was 105,000 if I recall initially. And we have our current liabilities at 16,800, which is an increase from where we were coming from because we have now improved our payment terms by paying when it's due, which is delaying our payments for the next 3 days, which is good for us. I just don't want us to mix it up. Receivables, you want to collect your money as soon as possible. Payables, you want to pay as late as possible, but don't let it go overdue. That's the trick there. So improving efficiency, notes on that, efficiency ratios should be calculated and monitored. So it's one thing to calculate it, but it shouldn't be a one-off exercise. We should calculate these ratios regularly so that we're on top of it. So ratios should be compared to the industry. When you calculate ratios for your business, that's just one part of solving the problem. You want to understand, okay, so is this a good thing or is this a bad thing? Otherwise, it would just be a figure in front of you. So you want to compare based on other businesses, similar businesses in your industry. If you're operating in an industry that you have publicly available information and you get a hold of their financial statements, I just taught you the trick on how to calculate ratios from people's financial statements. So you can, if they're public financial statements, you can go to their balance sheet and pick their inventory, and then go to their profit and loss statements and pick their cost of goods sold, compare with what your own ratios are and see how well you're doing. Trends should also be analyzed, and then the trends are usually your own self, that's your own business, analyzing your business over a period of time. So you're comparing the ratios against the industry ratios, and then you're also comparing based on what you have done in the past to see if it's getting better. If there are any adverse changes, you should investigate where they're coming from. And I've also told you the 3 sources where they could be coming from: your inventory, your payables, and your receivables. Improved operational efficiency can free up working capital. And this is basically, like we've been saying since, carrying less inventory, getting paid sooner, paying off later, basically, just the opposite, right? So, I mean, this is some of the resources that you can also use in conjunction with this session to improve your knowledge. I shared with the team already, and they will share with you at the end of the session, the implementation checklist. There's a glossary of terms. And then there's this website, on our CPA website, there's this page, 5 tips for building your cash flow. So the link is here as well. I will paste the link in the chat once I'm done with my presentation. So there you can see these resources, how to get control of your company's finances. These two are available on CPA Canada's website. So I will take any further questions at this point on anything that I have said, because it's important to me that you understand at least the basic concepts of monitoring your operational efficiency. So anybody has any questions?